Hi, I'm Richard Rosso, Director of Financial Planning for RIA Advisors. And at our firm, we get consistent feedback and information from people about their firm, their employers, because guess what? They're getting offered severance packages. It's very common for mature workers today to be offered packages which allows younger workers to come in to the workforce. So if you've accepted a severance package, you may be wondering, what's next? There are several points you'll want to consider. First is severance pay tax timing. So depending upon how your pay is administered, it's best to maybe have it paid out over a 2-year period or longer so you can avoid a big tax hit. So a lump sum might push you into a higher tax bracket, trigger higher ordinary income or capital gains liabilities, as well as a Medicare surtax. So it's a good idea to consult your tax advisor and then your employer's HR department to determine whether this is even a viable option. Naturally, working through your budget to make sure this strategy makes sense is very, very important. Next, you want to consider maximizing your health savings account contribution. An HSA payroll deduction is pre-tax, grows tax-free, and for qualified expenses can be withdrawn free of tax. The family contribution limit for 2019 is $7,000. The maximum contribution limit for individuals is $3,500. And if you're over 55, you are allowed an additional $1,000 catch-up contribution. You know, the greatest question we get is, Rich, and everybody here at RIA Advisors, lump sum or pension annuity? Well, the decision is a personal one. Don't be pressured. A formidable case can be made for each option. So depending upon the viability of the pension, your current age and health, the direction of interest rates, family longevity, the intention to leave a legacy to your family, and the current state of your finances, an objective certified financial planner can head you in the right direction. There are several ways that you can rebuild or recreate a pension for living expenses in retirement. So retirement plan distribution or not, most likely the wisest decision is to roll over your retirement plan proceeds into a self-directed individual retirement account held with a full-service financial firm or registered investment advisor. So what are the benefits of rolling it over if you decide that you don't take the pension? Well, you're going to command a greater selection of investment choices and hopefully lower costs. If you're younger than 59 and a half, but at least 55 years old, and you require distributions from your employer retirement account, it's best to leave the plan with the company and avoid the 10% early distribution penalty. This withdrawal provision is not available for IRA accounts. A fiduciary or a professional who has your best interests first can help you assess. Then you got to look at your stock option exercise strategy. You got to consider that because a strategy to exercise company stock options should consider your taxes, expiration dates, total household net worth invested in the stock of your employer. We recommend that RIA no more than 10% of your liquid net worth tied up in your company stock. You also must be very sensitive to post-termination stock option rules, especially for vested options. Companies are known to strictly uphold termination deadlines, so you have to exercise within the stated window, or guess what? You're going to leave money on the table, and we don't want to do that. And what about this process called NUA? Is it right for me? Well, have you accumulated company stock in a company retirement plan? Have you the option to complete an in-kind distribution of those shares into a non-retirement account? A net unrealized appreciation tax strategy can be especially desirable if the company stock has appreciated significantly. Through this process, the stock is distributed and taxed as ordinary income, but its original value or cost basis. From there, the shares are held in a brokerage account and not taxed until you sell them. At that time, you'll pay capital gain rates on the additional appreciation since the distribution occurred. So you're going to need a qualified tax professional or financial planner that can help you crunch the numbers and help you best understand the pros and the cons of the process. Then you have to really get a handle on healthcare coverage, including COBRA. So a common mistake for those who are eligible for Medicare is to sign up for COBRA coverage which extends your company group health coverage insurance with higher cost, and postpone taking Part B Medicare insurance. But keep in mind, enrollment in Part B is required if you accept COBRA. If you do not sign up during the 7-month initial enrollment period, you are going to be charged a late enrollment penalty of 10% of that Part B premium for every 12 months you go without coverage. This penalty is assessed for as long as you have Part B coverage. In other words, the rest of your life. If you would like to receive a severance kit assessment and expanded information about the points I've outlined here, please contact us at RIA Advisors to discuss your personal situation. I'm Richard Rosso, Director of Financial Planning for RIA Advisors, and we thank you for watching.